Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. The market moving CPI from the US is out now. This caused some significant moves in the market. Dollar took a beating, gold rallied, and Fed rate cut probabilities for September meeting moved higher. Morning, JK, your thoughts on the US CPI and the subsequent moves?
Good morning. Yes, the number yesterday was really heartening for people looking for rate cut expectations. And, significant fact is that the prices actually dropped month on month in June. And that's happened for the first time in the last 4 years. And the decline also put annual inflation at 3%, which is the lowest in more than 3 years. So that was the first, heartening point. And more significant was the fact that services inflation has been cooling. In addition to pullback in energy prices, there was a modest increase in the shelter rates that was 0.2% versus 0.4% earlier. Used vehicle prices or rather rose at a much slower pace. And overall, it was down 10.1% from a year ago. So that has been one of the main drivers of inflation surge in since 2021. Medical care. So overall, the services inflation itself has been lower at 0.1%. That is reduced after reducing the energy prices. And this is now at 5.1% year on year. So these positive development definitely increased the market expectations of a September rate cut to 92% from 73% that was seen after Powell's testimony on Tuesday. Although a move in July looks still very low probability, a very minor number of participants in the poll expect even a move in July. But I will not totally rule it out because we have some more data for Fed to consume before they meet. So that can give some push for at least a dovish statement from July, from their July statement. And also, what the fall in consumer prices indicates is that possibly the demand is slowing down, and the fall in consumption means that economy is overall slowing down. We will also look at how the GDP comes lower. So overall, a decline in the economy. And if you recall what Powell had stated in the second part of his testimony, that now they are looking also at the risk of economy taking a hit due to high rates, apart from focusing on inflation target at 2%. Now, in the face of sharp fall in the inflation number, lower jobless claims was overshadowed. But however, notable is that the continued claims, which is the more representative of the employment situation, has been rising steadily since April. Although it was slightly down in yesterday's data by 4,000, and this actually is consistently with the unemployment rate rising to 4.1%. Now, if you look at the US economy, a rate cut is much needed because we know that housing demand has slumped amid higher prices as well as higher mortgage rate. Even the total consumer credit has been slowing in the last 2 years after reaching a peak of 10% in 2022. And in last 24 years, such a rapid slowdown in personal debt has been seen only in 2000, 2008, and 2020. So we are somewhere in the region where we had seen recessions setting in. So a much needed rate cut from Fed is expected, and definitely consumers are struggling without that. Now, market reaction: yields slumped between 10 and 13 basis points between 2 and 10-year yields. But the stocks saw a very mixed performance because mega caps declined sharply with Nasdaq posting more than 2% decline and the S&P more than 1% decline. But their declines are down to more of profit taking, and also their in the much awaited rate cut being very near. So we saw profit taking, but at the same time, small caps have rallied strongly. The broader economy is actually now taking heart from the expectation of a rate cut from Fed happening earlier in September. So mega cap, rally was more than 3%. Now, coming to US dollar, I would say knee-jerk reaction was always going to be bigger. But then overall, if you see from the CPI of May, which for the first time showed a 0.0% increase, following by PPI, which was soft, and then the core PC inflation also coming soft. The latest CPI reading showing prices actually dropping. Dollar index has hardly moved. It has ended 12. It had ended 12 June at 104.64, and today it is at 104.48. So dollar is not really, getting a big move from these rate cut expectations or inflation dropping. I think that these are well within the market pricing of the dollar, and probably we need much larger trigger for dollar to make a move. And one such trigger can be the US politics, which can be, market moving. But notable yesterday was the yen volatility, which fell more than 2% after the data. There was a rumor that, Bank of Japan had actually made use of the, soft dollar situation to intervene and pushed it down to as low as 157.5. But then since then, it has bounced to above 159. Officials have been denying that they had intervened, but they are saying they're watching. So yen will be very interesting to watch, because the yield difference between yen and US has narrowed down substantially. Coming to India, of course, the Indian rupee had a very marginal movement after the CPI data, dropping to around 83.50. Since then, it has moved to 83.54. Notable yesterday was a strong demand for USDINR from prominent PSU banks. We are hearing about large outflows for government debt repayment that kept the market on the bid side steady, and there was no major intervention from the central bank also, which could keep the dollar down. So we have actually expanded the dollar rupee range to the higher side, above 83.50, touching a high of 83.59. For the rupee, we are also looking at the retail inflation for June that will be released today, expected to inch up to 5.1% from 4.75% seen in May. And this is on the back of food price inflation, particularly the vegetable prices that have increased, but the core prices are expected to be remaining muted. So all this is unlikely to influence RBI's monetary policy, which will, I think, remain restrictive at the current rate, at least till the last quarter of this year. Overall, dollar rupee range, I think, is now slowly building to a base above 83.40-45, and then a gradual move to 83.70-75 is not ruled out if the demand continues, because as we see in the month of June and July already, we have had nearly 5 billion of inflows, but that has not made much of a difference to the dollar. So we are seeing the inflows getting absorbed by the outflows actually having an slight impact. And if the central bank is not very heavily intervening, we might see a slightly higher range for the rupee towards 83.75. Thank you.
Thank you, JK. And just to quickly summarize, inflation was lower all across. Even the services inflation cooled, which was a significant point of concern for the Fed. The September rate cut probabilities are at 92% against the 78% probability post Mr. Powell's testimony. Of course, the market reaction was yield slumping. Stocks had a mixed performance while small caps rallied strongly. But in the larger context of things, one important thing which JK mentioned was that when we compare the CPI print from June versus the CPI print yesterday, dollar has hardly moved. On a month-on-month basis, dollar is back where it was literally a month back. For rupee, there was a strong demand for dollars from PSU banks. on account of some large outflows for government debt. No major intervention by the RBI. And today, of course, we have the Indian inflation, which is expected to inch up on the back of rising food costs, but the core inflation is expected to be muted. That's it from us today. Thanks for listening. Have a very good weekend and catch us on Monday for the latest from the financial markets.